Okay, this is a panel discussion, as I said, and the way we're going to do this is I'm going to introduce you to each one of these individuals, and then we'll kick off on the discussion. We're really lucky today to have this group. We have three people here, Farhad Abazov, who is the president and CEO of Alana Potash, Ramzi Fawaz, towards the end. He is the senior vice president of operations and projects at Newmont Mining. And in the middle, Abdul Aziz Al-Najim.
Yeah, you pronounce it well.
Thank you. Who's the director of the ETGAN transformation program at Mahadan.
Ma'aden, yeah.
Mahadan. Maybe we should just start by giving them a moment to introduce themselves. Maybe we start with Farhad.
Sure. Thank you, Paul. And good morning, everyone. I represent Alana Potash. It's a development company building a potash mine in northeastern part of Ethiopia. It is one of the largest potash deposits in the world, and I'm very glad to be here to talk about it.
Great, thank you. And Abdulaziz?
Yeah, I am here representing Ma'aden, Saudi Arabian mining company, and I'm leading a transformation program, which is a strategic initiative in the organization, and that is about building capabilities and processes for sustainability objective in the organization. And I'm glad really to be here, really to participate in this panel. Thank you.
And Ramzi?
Yeah, thank you, Paul. My name is Ramzi Fawaz. I work for Newmont Mining Corporation. I'm a senior VP of projects. Some of you may know Newmont Mining is a gold company, predominantly 90% gold and 10% copper. Myself, I'm responsible for the projects, major projects in Newmont. So we have operations around the world, in Nevada, in Peru, in Suriname, Ghana, and in Australia and New Zealand and Indonesia. My job is to build new mines and expand them. And I'm really glad to be here today to share this panel with you.
Very interesting. Maybe I'll just kick off the discussion with a general question. I think all three of these gentlemen find themselves in between their investors, their shareholders, and the governments that they have to deal with in the different countries that they're operating in. And one of the issues that I expect all of them has faced in the past 2 or 3 years is falling commodity prices, and what that means for the profitability of the projects and the viability of the projects in some cases. And what I would like to ask them all really is whether they have, what sort of response they've seen in the reaction to this. I mean, your shareholders are certainly aware that that's going on. To what extent are the governments that you're dealing with aware that that's going on and dealing with that issue by coming up with perhaps better terms or easier operating conditions than you might have been able to get 3 or 4 years ago when commodity prices are higher? So how much flexibility are you seeing, and how much adjustment are you seeing from the governments that you're dealing with? Maybe I could start maybe with Ramzi on that.
Okay, thanks, Paul. Yeah, I think understandably the governments, whether in the Middle East or in Africa where Newmont is busy operating, would like to have more share of our operations and projects, and understandably so, because they want to have better economic development, they want to have better employment and sharing of wealth to their country and to their people. So this is understandable, and the mining companies like mine want to work with the governments to make that happen. Of course, the expectation is sometimes higher than what those marginal mining projects are, especially at the time of low grade in terms of my business, gold mining. And how do you meet the expectations of the host countries together with the investing companies like ours? And it's a question of education, question of talking to the governments, understanding what they want, understanding how we can contribute to their economies, both regional and the whole economy, but also letting them know, what is the value of the projects that we have in mind, how much money does it cost us to produce an ounce of gold, for example, and making them understand what that is before we actually embark on a gold project. Now, we didn't do ourselves service in previous years, because in gold mining at least, when we talked about prices of gold and talked about the cost of producing in gold, we use what we call the cost at sales, or CAS, and that's only a fraction of what it takes to produce an ounce of gold. So of course, understandably, the government thought, well, if the price of gold is $1,500 or $1,300, and the cost of sale is maybe $500, the difference is quite a lot, and we would like to have a share of that. And then it's up to us to make it clear that it's not just that cost of producing an ounce of gold, but there are other things like sustaining capital, dividend, and so forth. So it's a question of talking, educating the governments, discussing openly and frankly what it takes to open a new mine, to explore and find it and then develop it, and then having a reasonable expectation of what the tax and royalties are for such a mine.
Maybe, Farhad, you've had a great success with your government.
Well, I agree with Ramzi in that you have to perennially interact with the government to not only educate them, but also understand their requirements and long-term plans. Because if you look at these mining projects, we're talking about multi-decade projects. So you got to look at the long-term investment and also long-term benefits for the government. So in Ethiopia, we have a very fortunate situation because the government is quite understanding of our needs. We are planning to produce potash, and potash as commodity has not been immune to price fluctuations in the last several years. So we're talking about $300 to $350 per ton potash versus $450 potash per ton and dollars per ton. So we had to go to the government and explain the situation. And also, as Ramzi already mentioned, you have to really explain to the governments, especially in the case of Ethiopia, which is not really a very well-known mining jurisdiction, that how we raise capital, especially for smaller companies. It's a combination of debt, equity. You have to tap into international finance markets, and how it is done, and what kind of expectations are on the investor's part. So in our case, after long discussions with the government and finally their understanding of the situation and circumstances, we're lucky that they've actually taken on a lot of investments, especially in terms of infrastructure development. And it is substantial because we're talking about hundreds of millions of dollars off the shoulders of the smaller company. So that allows us to both take the project to construction and production, but also meet their requirements, their expectations, because in the end, both sides are obviously interested in taking a project to production. So we believe that it is important that the governments have long-term policies and also stable jurisdiction in terms of how they see these projects develop. Because in the end, it's not about maximizing the revenues for the budget today, it's over the long period of time. And because if they try to maximize it today, that is very simple. The outcome is that project may never see the light of the day, which means that obviously nobody's going to win from it. So I think it is critical that the governments take a pragmatic approach, and the companies also work together with the governments in order to educate them and explain how the entire process works.
Thank you. Maybe Abdulaziz?
Yeah, I may add that's in our case, we have probably good, really, relationship with our government, with a trusted relationship with the government, which that's really enable our long-term investments. And and enabling us also to access the necessary infrastructure within the organization with favorable really, way of really getting that. And we know that the prices really affect is really often is unpredictable, and normally when you start your economic evaluation, you start with a certain paces, and that's really most of the time is really out of your control. But this type of relationship helps really to get these understood at the right time and put the right strategy and measures in order to bridge these requirements. That's really in brief.
Mhm.
Thank you.
Thank you. Ramsey, actually, I'd like to ask another question. You deal with a lot of different countries, and it was interesting. One of the points that David Hale was raising is how much, for example, what's going to happen in the BRICS depends on politics. Do you see at this stage in the cycle growing resource nationalism in the countries that you're dealing with, or?
Yeah, we've seen various demands and requests from various countries, and let me just say, not just in developing countries, but also in developed countries. So, for example, in Australia and in the U.S., more ask for tax and royalties, and it comes really in three forms. It's either because again the host countries expect to get more revenue and better economic development. So it's either more tax and royalties is what the ask is, or it's more employment and more infrastructure type projects associated with the mines that we develop. And third thing, it's more ownership of the projects and mining operations that we have. So we see it in sort of three facets in our operations. Has it gone, has it become more in the last few years? It had a period, at least in our gold industry, where we did see a rise in 2011, 2012, but in the last 2 years, it has, I think, more stabilized. And again, as I was explaining earlier, it's a question of discussing and dialogue between us and the various host countries. And as I said, it's not particular to, for example, Africa in our case, but overall, general in the world. And what we're seeing now is more a moderation of those requests, and therefore more opening understanding of dialogue, as I think as we were saying, in terms of long-term development and a long-term strategy for developing those mines.
Thank you. We have a question here from the floor in front.
Copper, mining copper. Is it the time of the mining of the copper, which we have small projects or small deposits, which low grade, even 2% or lower than that? This time, it is the time of the mining small projects or small deposits for copper, especially in our case in Oman. Is this profitable in this time to mine the copper?
Sorry, Kabul? What is
Copper.
Oh, cobalt. Sorry,
Cobalt.
I'm sorry.
Ramsey.
Does anyone have any view on that?
Maybe I can try and answer, because it's always difficult to predict what the market is. And Dave was explaining what the market movements.
The deposit is around 20 million tons.
Right.
With low grade of the gold associated.
With the copper.
Yeah. Is it 1% or lower than that?
Surprisingly, the copper price has stayed reasonably stable in the last period, despite the fact, for example, that iron price went down and even gold. Copper stayed reasonably flat, gone down a bit. And it's a question of supply and demand around the world. And as you probably have seen, The supply at this time is more than the demand. So there are a number of large copper projects coming on stream, including in Peru and Mongolia. So we expect that the supply will be a little bit more than the demand in the next 2 to 3 years. But the expectation is with the growth in China that it will catch up, and therefore there will be again a requirement for, is our expectation, for more copper supply, therefore new mines. Not in the immediate future, but in the say medium-term future, 3-4 years. That's our expectation.
Thank you.
Question in the back.
Thank you very much. My question is to Mr. Fawaz. Do you partner only with government or also with individuals that are into gold mining?
Well, we have various type of arrangements. Of course, my company Newmont, we sometimes have governments as our partners, like we just announced a new mining project in Suriname in South America. And there, the intention is that we partner with the government, 25% for the government, 75% for Newmont. That's the option that the government has. They can earn in up to 25%. We have also worked with other joint venture partners in Peru, for example, in Indonesia. So we've done it both ways, of course, and then we have many mines where we operate 100% ourselves. So we have a combination of 100% ownership and joint venture partnership with other mining companies, and in some instances with governments.
Is there another question in the front? Yes. We get a microphone in the front, please.
There's another question. There's another question.
All right. We'll get you.
Thank you. I was wondering about China and the United States. As we know that they have a huge reserves of oil shales. And still we know that the technology and the production cost per barrel is very high. So generally speaking, how long will it take, either for China or America, to control or to control the equivalent oil as a production cost in order to be economic? Got me? So, as we know, that the oil shale production is too much higher than the normal oil and gas. Okay? So, how many years do you think that China will need in order to control or to get proper technology and to make the production cost of oil shales is equitable to the normal oil, and when is going to be encouraging this technology? When is going to be encouraging? If anybody, gentlemen, thank you.
I'm not sure this panel's really qualified to answer that question.
I'm sure they have a background about
if anyone has any, because that's really an oil and gas question, and these are miners. But if anyone here has any insights on that, is any? I don't think so. No, I'm sorry.
That's all right. That's okay.
Yeah, maybe we'll go on to the next question on the right.
Assalamu alaikum.
Hello.
Hussein Zubaydi from Oman. Just I have one question regarding maybe to Mr. Ramzi. Ramzi, regarding the royalty, how much royalty did you pay to the government? Second question about the local community. what do you think the best solution to solve this problem between the government and the investors? Is it to pay like 5% from the income to the local community, or you share them with the different project? Or what do you think?
Yeah, good question. Thank you.
Thank you.
Obviously, the percentage royalty differs in various countries, and depending on when the projects were initiated, built, and where we are in the timeline of a project. But I've seen them varying between 3 to 6%. So depending on the country and the age of the mine and so forth. Your second question about local communities is an interesting one. 3 to 6%. Yeah, from the revenue, and but in terms of the local communities, it varies. And what we try to do, at least in my industry, is either we have local type projects, regional projects to develop infrastructure, help with maybe healthcare or water supply or sanitation, and that is by direct implementation of local water projects, and I'll speak to that in my presentation later. In some other countries, again, it depends on where they are. There's sometimes a percentage of what you generate, like 1%, goes to the local community. So it depends how you do it. Sometimes it's a percentage of your revenue, sometimes it is direct investment in the local communities in terms of regional projects and local projects.
Yeah, question just from the floor here in the middle. We have a microphone.
I have a question to the panel, really. We have recently seen some quite massive labor unrests in various countries. What is the response of the mining industry to that? Does it mean more automation? Does it mean a shift from countries to other countries?
Does anyone want to respond?
Yeah, sure, I'll respond. Obviously it will differ from country to country, but I'll give you an example of Ethiopia, where right from the beginning we've decided that we'll create as many employment opportunities for locals as possible. And the reason is very simple, is just we'll look at it as a long-term investment. In other words, we're selling potash, obviously there are budget revenues for the government, but you have to develop resources, human resource in the country. And what we'll leave afterwards, after 25, 30 years, is that basically skill sets for the locals where they can apply it in other industries or other businesses and so forth. And what we've noticed that was probably the best decision. It was an internal policy decision, a corporate decision, not necessarily government constraint or government requirement. Because what happens, it creates obviously a goodwill with local government, local communities, but most importantly, it really also reduces our cost of doing business. And I think once you realize that by investing in the local community, you actually are achieving your corporate goals, then the issue of having this tug of war between the government objectives and the corporate objectives really goes away. Now, and that also really preempts any potential labor unrest down the road. I think in some other places, obviously, this has not been a consideration. And then the corporate reaction is basically trying to resolve the issue after the fact. And it's obviously always harder. And then you start looking at higher cost ways of resolving that issue, including automation, more mechanization, and so forth. Now, sometimes it does make sense to go that route anyway from purely business perspective. But I think in many cases, it's best to really take into consideration, I would say, the confluence of objectives or interests from both the local community and the corporate side.
I may elaborate on this area. This is really a good question, and in our case, as our objective is really to be, we are in Ma'aden is really the leader of mining and mineral industry in the Kingdom of Saudi Arabia. And this is really a real challenge always when you come to people. And as we are developing this type of industries, we need also to develop really our vision towards creating the job, which is really the main objective of doing those all investments, creating jobs within the country, developing industrial cities, and also ensure that the communities that you operate in are prosper and really getting advantage. So creating jobs, this means you need to develop people to that particular requirements, especially in the mining. It's not really something was known, mainly in Saudi Arabia. Gas, oil and gas was the main really industries in the region. Now with the mining, we have to develop our high schoolers in order to develop them in the technical area, to be a miner, to be in technical terms. Also, we have to really get university graduates in order to be developed in this area. And there are programs within our country in order to develop that. But at the same time, while we are developing and we are having this strategy to develop our own internal resources, Saudi nationals, we are also balancing with external outsource in order to bridge these gaps. So there are development internally and externally for our people. And I give you example for the aluminum business. When we start commissioning this plant, we had to really bring operators to run these plants, and we had to really get them trained, either in the premises of our joint venture, Alcoa, or our neighbors' aluminum manufacturer in the region. And there was certain program developed in order to develop them and make them ready. And that was so successful. And we managed really to meet the commissioning startup date with our own resources. There is always a mix between the national local developed team as well as the external outsourced people. But always in our investments, we are trying really to balance this very well in order to, in long term, get really the nationals are developed and ready really to take over at certain point in time. I hope we answered your question.
Okay, any other questions from the floor? Okay, is there one? Okay, please. Yeah, go ahead.
This is a question for Farhad. What's your prognosis of potash price, considering the alignment and consolidation of the potash cartel?
Yeah, that's a very good question. As you know, the sector is very interesting. It's been cartelized for a long time. So it's basically 70% of the potash supply worldwide comes from Canada and Russia. Last year we had a breakup of one of these cartels, of the Russian and Belarusian cartel, and that brought the potash price down substantially. But what it also has done is to really reduce any potential supply coming online anytime soon. So for the next 2, maybe 5 years, most of the potash that has been planned, or most of the potash expansion plans, have been put on hold or have been canceled. So my personal view is that we'll have probably this potash price environment for the next 2 to 5 years, between $300 and $350 per ton. But eventually the potash price will probably come back up to about $400 per ton because there will be supply constraints going forward. The major unknown in the sector is, of course, a large project being developed in Saskatchewan by BHP Billiton. And that is a massive project, about 10 million tons a year. Initial stage will be 5 million tons. And if that comes online, obviously it will dampen the potash prices in general, but we don't believe it's coming online anytime soon. So I would say at $300 to $350, a lot of low-cost producers will be having very healthy margins. However, it will put pressure on high-cost producers in Europe and some Middle Eastern countries and South America and the United States. but Russians and Canadians have very low-cost production centers, and I think they will be in a very good shape. And so will be Alana, because the basin where we are in Ethiopia, which encompasses both Ethiopia and Eritrea, I should say, our cost structure is quite low. So we think even at $300 to $350 per ton, we can operate a very profitable mine going forward.
Maybe if I could just add a question on this. You've talked a lot about supply. My understanding is that one of the reasons you were able to draw the strategic interest that you have is the potential demand in Africa for potash and fertilizer. Could you maybe add to that?
Yeah, it's a very good question, Paul. The potash consumption is mostly in major countries. So we're talking about, obviously, China, India, Brazil, United States, West Europe. However, Africa is the frontier market right now as far as not only potash, but most fertilizers are concerned. The reason is very simple. If for the last 20 years we've been thinking and talking about African miracle in terms of agricultural development, today it's happening. And I'll give you an example of East Africa specifically, and Ethiopia perhaps, is that for the first time there's what we call a fortunate confluence of all the positive factors. Rural infrastructure is developing very fast. A lot of investment is coming and flowing into agriculture from outside. So FDI in Ethiopia alone has been tremendous, in billions of dollars coming to agriculture and really transforming the sector into export-oriented industry. For the first time in their history, Ethiopia has become self-sufficient in food. That's a huge achievement for the country that has been, as you know, experiencing recurring famines for the last several decades. Now, the key thing here is truly the combination of all these events, because it's not only about the money coming in and transforming these sectors, but it's also availability of infrastructure and also education of the farmers on the use of fertilizers, specifically potash and phosphates. Now, what we've seen in Ethiopia and other parts of East Africa is not only these developments, but also translation of all these factors into real deeds, into real actions. In case of East Africa, we see both the announcement of the plans and start of construction of NPK blending facilities. So basically, these are large fertilizer blending plants that will be using potash, phosphate, and nitrogen as input products to basically blend them into fertilizers that can be applied directly to the soil. Now, Ethiopia has announced the construction of 4 NPK plants. So did other countries in East Africa, including Kenya, Tanzania, and Uganda. Now, that means that today we're looking at about 100,000 tons of potash consumption in East Africa. In 5 years, we're going to be selling 400 to 500,000 tons per year to this part of Africa alone. That's a huge demand growth. Now, just to give you a contrast between what we use in Canada, North America, in West Europe, and in Africa, just in terms of potash, you will see a huge contrast and huge upside potential for Africa. In West Europe, we use about 44 kilos per hectare. This is a potash use. In Canada, about 30 kilos. And in Africa, it's barely 300 grams. So even if they go up in their consumption by 10 times, they're still going to be lagging behind all the Western world. So we're talking about tremendous growth potential for Africa. And as you know, it is a huge agricultural area as well. So we're looking at Africa, specifically at East Africa, as a breadbasket of not only the rest of Africa, but of the world going forward. So that's where we see the potential in that regard. And going back to your question, Paul, that's a reason we could attract large strategic investors, because not only do they see cost advantages of the project, but they also see a ready market for our product once we're in production.
Thank you.